You got to do a great job at underwriting the deal in the beginning of the deal when you buy it. Because if you don't get the after repair value correct, by the time you go to sell it, by the time you go to refinance it, the money won't be there. If you are out there trying to get your first real estate deal, you've been saving up, you got some money, it's burning a hole in your pocket, oh, you cannot miss this video, okay? Part one was so good, I decided to do a part two because we just got to keep going. We talking about how do you properly underwrite deals to keep yourself from losing money, because we make our money in real estate when we buy, which all it means is this. You got to do a great job at underwriting the deal in the beginning of the deal when you buy it. Because if you don't get the after repair value correct, by the time you go to sell it, by the time you go to refinance it, the money won't be there, right? And we do this whole this idea of real estate investing to make more money. So why lose it? Well, I'm gonna help you not do so. All right. So in the previous video, we talked about, what's the after repair value. I'm not gonna cover all of this. You got to go back and watch the other video, comps part one. Okay. But essentially, comps are sold properties. Emphasis I'm putting on sold properties that are comparable to the subject property that you're looking at. Okay, and so we talked about, it's got to be a certain square footage when you're looking at comps, right? Plus or minus 500. It's got to be within a certain mile radius, half a mile radius, right? Architectural style needs to add up. Bed bath count needs to add up. Days on market. Okay, but now we got to talk about some new ones. Yep, I told you. I wasn't playing with y'all. You got to go back and watch the other video. All right, because I got to write some other stuff up here. So here we go. Now, after days on market, okay, and I covered a lot on days on market in the previous video, so make sure you go watch that. Days on market is so important in today's market where interest rates going up, stuff is sitting on the market longer. That means something when you go out here and you investing in this climate, okay? So aside from days on market, we got to look at garage, no garage, right? Garage, no garage. That's important, y'all. If you is, in certain markets, especially urban markets, some properties may have a garage, some may not, right? A lot of these homes are built in the 1900s, early 1900s, things of that nature. And so it's important that you look to see if the property that you're comparing your property to has a garage or no garage, if you're in that instance. What's another important? Basement, no basement. Right? Basement, no basement. That's another critical one, because you may be up north, right? Northeast, wherever you may be where they have basements, even some places in the South. It's important that you understand if you're sitting on a crawl space, your property won't be as valuable more often than not than a property that has a full basement. Or if your property has a partial unfinished basement versus a completely finished basement. Okay. And this is a major key. This is an outlier for basements. Okay, I'm giving y'all a bonus. All this a bonus. Like all of this, just so y'all know, I teach all of this in great length. I'm talking about hours on comps inside of our program. And I'm giving this to y'all. So don't take this lightly. Make sure you don't hoard the information. Share it. Give it to a friend. Give it to an aspiring investor, because this stuff will put you in the driver's seat to heading towards the money instead of away from it. All right. So basement, no basement. Now it's important in the basement that we understand. So let's just say if you had 3 bedrooms and 1 bath in the basement. Okay. And then you got 4 bedrooms and 2.5 baths upstairs. Okay? So you got 4-bed, 2.5 bath upstairs. You got 3-bed, 1 bath in the basement. How many bed and baths do you have in the house? Like, let me know in the comments. Type it in the comments. You got 4-bed, 2.5 baths upstairs. You got 3 beds, 1 bath in the basement. What's your bed bath count? Okay. I know. Y'all like B. It's simple math. I get it. So you got 7 beds and you got 3.5 baths in the house. Right? But watch this. An appraiser, when they go in to figure out the value in your property, okay, they have what's called above ground heated square footage, which means that they're only going to count the 4-bed, 2.5 bath upstairs. Now, intrinsically, yes, a buyer could see value in the fact that you've added 3 additional beds and 1 bath in the basement. But so many people go wrong by making certain updates in their property, not realizing that an appraiser is not going to count that towards their value. Now, that don't mean don't put the money into the house, but understand that you may not get it back out, and you need to evaluate how you spend the money in the house and understand what things are counted as actual value, right? Because intrinsic value, this would be what's called intrinsic value, right? The intrinsic value is the 3 beds and the 1 bath that's in the basement. And what that means is intrinsically, if I got a family of 5 and we move into this 4-bed, 2.5 bath, you better believe that the basement bedrooms got some value to me intrinsically. I'm like, oh my God, I could stick an office down there. I could put an extra kid down there, right? If 2.5 people occupying other bathrooms upstairs, I legitimately have a bathroom in the basement I could go use. So intrinsically, that is appeasing to me as a buyer. But from an appraisal perspective, they're going to be dealing with actual value. And above ground heated square footage is what they're going to be dealing with. I just gave y'all so much game, I could stop this video right now and let y'all go print this money. But I'm going to keep going. All right. So it's critical, right? Garage, no garage, basement, no basement. Understanding above ground heated square footage versus below ground heated square footage. This is a major one. Right? Does the property cross major roads? And if it does cross these major roads, does it end up in a different neighborhood, right? So one of my markets is Detroit. In Detroit, you can literally, within the same zip code, cross 5 different neighborhoods that will span from, I don't know, like 150,000 ARV all the way up to 450,000 ARV. All within the same zip code, y'all. Like literally. So, and it's just a function of crossing these major roads puts you in different neighborhoods, although you're in the same zip code, which is why you can't comp out based on zip code. In some cases, you can't even comp out based on half-mile radius. You have to get as close as a quarter-mile radius to make sure that you stay within the same subdivision, neighborhood, etc. And so, as you can see, right, based on this video, and if you already watched the last one, it's so much nuance to going out underwriting these deals to make sure that you get the values correct. Because if you don't, and you don't use all of these elements and you start making these assumptions based on what your realtor told you, based on what Zillow told you, my gosh, light Zillow on fire. Based on what the neighbor's telling you, your aunt, you got to stop listening to all this subjectivity and opinions because free advice is expensive, y'all. This is paid advice. I'm just so happy to be donating it to you today. All right. So look, now, given all of that, okay, once all the elements of the comps line up, then you have to start looking at the actual date that the property sold. Okay. So, date of sale. Okay, this is critical. All right. Date of sale, because you want to know did this property sell I guess I could have drew a little property. There we go. Did that property sell within 6 months? Okay. Now, appraisers will go up to a year if they need to, but they're really going to look at comps within the last 6 months. So when you evaluate your deal on the front end, whether you should buy it or not, you need to be looking at comparable homes that fit all of that criteria that I gave y'all within the last 6 months. Okay. 3 months even better, especially in today's market where days on market are starting to extend. Interest rates are going up. Affordability is changing for home buyers. You really want to be looking at properties within the last 3 months when you're looking at comps. Because 6 months ago, when the market was still pretty consistent, because rates were teetering low, high fives, low sixes, you can look at 6 month data and still be pretty good. But now with the way that the rates are going and they continue to increase, you want to look at the last 3 months to keep yourself safe so you're not out there lighting money on fire. If you got money in your pocket, right, i.e. bank account, all the rest of it, it's so important that y'all get this right so that you're not going out here and all the hard work that you've done and due diligence and building up some reserve that you go out there and set it on fire because you're listening to the wrong people, y'all. You cannot afford to do it. Okay. Now, and this 10 should really probably be 1. Your comps need to be so, I told you I got the handwriting over for the position. Sold properties. You want them to be sold properties because it's too speculative otherwise. Oh, there was a property down the street that was on the market for $350K, right? Okay, great. Problem is though, if you base your comps off of an active listing, then you don't know really what it's sold at. Maybe it doesn't sell. Maybe this thing sit on the market at $350 for 3 months and they forced to lower the price down to $290. But you base your evaluation off of ARV at $350, it sell for $290, and guess what happened? Now your best comp is $290. So you go put all this money in this property that you rehabbing, and all of a sudden you all in at $275 thinking you can get $350, but your best comp was $290. So your property not gonna sell for more than $290, and then all of a sudden, guess what you got? You got a big L on your hands. We avoiding those this year. Y'all with me? Okay. So what's the moral of my story? The moral of my story is real estate has a lot of intricacies to it, right? And the details and your ability to navigate through those details is what's going to put you in position to make money or not. Everybody can get lucky in a good market and make some money. Okay. But you will not have a sustainable business until you get efficient and proficient at these things. And this is just the tip of the iceberg, but it's the most critical because if you don't determine your value correctly on the front end, you won't have any money on the back end. This goes for y'all that want to burr. This goes for y'all that want to flip, and everybody in between. You have to get proficient at understanding comps and determining value. All right. Now, if you somebody out there and you got some money and you want to do the right and responsible thing with it, here's what I'm going to tell you. I have an opportunity for you to join me for 5 days at our next 5-day challenge. Okay. Day 1, I'm going to teach you guys the difference between traditional and remote investing, how to use remote real estate investing to take your business to a whole nother level. That's what we specialize in. Okay. Had I stayed only doing traditional deals, I wouldn't have been able to retire from work by the age of 35. Okay. Remote investing is critical. Okay. Day 2, I'm going to teach you how to build a 7-figure business in 12 months in about 4 or 5 steps. Okay. Pragmatically. Day 3, I'm going to teach you the psychology of becoming an OPM magnet, how to go out and attract money for your deals to where you can do deals with no money out of pocket, as myself and 90% of our students do. On day 4, I'm going to teach you how to buy your time back through our time freedom cash flow formula. Okay. It's time for you to start to tangibly put some things in place to get you an action plan to finally leave your job, to finally unwind or step away from your business, whatever the case may be. If you're a practitioner, how to get your time back. And then lastly, on day 5, we're going to customize an investment plan specifically for you because your goals are unique to you. And all the while, each day, on top of that 1 hour each day, you're going to get a special hour with me in VIP where you get to get live coaching from me at a fraction, an absolute fraction of the cost. Normally, my coaching fee for 1 hour is $10,000 for my consult, right? And it's not because I'm crazy, because people make a lot of money and sitting down across from me in that very short period of time. You be no different. You guys get to come get a VIP ticket for $297, and it comes with a 10 times better than money back guarantee. So Friday of the challenge, if you feel like you didn't get $2,970 worth of value, send an email over to the team. We'll give you your $297 back. Yes, you heard me correctly. I didn't say if you didn't get $297 worth of value. I said if you didn't get 10 times that in value, we'll give you a $297 back. Quite frankly, if you spend 5 days with me and don't get $3,000 worth of value, I don't want your $297. All right. Share this, like this, comment on this, subscribe to this. Make sure you send this out to people that you love to keep them out of harm's way. Also, go back and watch the first video as well. I'm telling you, this stuff right here will change the game for you and your business. I look forward to meeting many of you at the challenge. You could click the link in the description. Also, go to www.iflipchallenge.com and you can sign up there as well. I'll see you guys at the challenge, and I'll see you in the next video.